Trade tension is certainly a key market risk right now and will impact on Asian markets in three main ways. Firstly, directly on those companies or countries engaged in the activities that are the specific target of trade tariffs. Secondly, indirectly through the impact of trade tariffs on Asian and global economic growth. And thirdly, indirectly through increased market volatility caused by the uncertainty around the trade tensions and subsequent risk aversion. The situation will continue to evolve and the end game is difficult to determine at this juncture. What we do believe is that trade wars are not beneficial to the global economy as a whole, and it is not what many economies want to see. We are monitoring the developments closely and will adjust our portfolio positions accordingly. Having said that, the largest industry sectors in the Asian credit market include financials and property. These sectors are more domestically orientated and have less direct impact. However, tariffs on industries such as steel, for example, will have indirect impact on industries such as the property sector. These are some of the things that we are thinking about in our positioning around trade tensions. There are many reasons why Asia is an attractive place to invest in, now and also for the longer term. Firstly, Asian growth rates are amongst the strongest globally. China has indicated a 6.5% GDP expectation for this year. And most other ASEAN emerging Asian economies are also expected to grow by 5% or more on average. Secondly, Asian sovereign fundamentals are stronger compared to other emerging market regions. The 10 major Asian economies today are rated investment grade by all three international credit rating agencies. Looking specifically at the opportunity in Asian fixed income, yields are higher than developed market yields, offering good yield enhancement within a relatively stable fundamental backdrop. Asian corporate default rates are expected to remain relatively low for this year at around 2 to 3%. This low default rate is more than compensated by current spread levels. While the US is normalizing monetary policy, we believe the Asian rate hike cycle will be much more measured compared to the US, as inflation remains broadly within Asian central bank targets. The key potential headwinds for this year include developments around trade tensions, faster than expected global central bank policy normalization, especially the Fed, rising inflationary expectations, as well as geopolitical risks. We monitor these factors closely to assess the potential impact to our portfolios and will adjust our strategy accordingly as the need arises. In a gradually rising interest rate environment, compared to other asset classes, Asian high-yield bonds offer the advantages of higher yield buffer and lower duration. What we mean by this is, with a higher average yield of around 7% for the asset class as a whole, this provides a good level of buffer for downside risks. Duration is a gauge of the price sensitivity of a bond to a change in interest rates. Because the Asian high-yield asset class has a lower duration of around 3.5 years, it is less sensitive to rising interest rates. For our Asian high-yield strategy, we also actively manage the interest rate exposure of the fund to help mitigate potential portfolio downside risks if interest rates rise sharply. So with attractive yields, lower interest rate sensitivity, and low default rate expectation, we believe the asset class remains an attractive investment proposition in a gradually rising interest rate environment. In a more volatile market environment, we believe it is important to be nimble. This means having good flexibility to both take advantage of opportunities that a volatile market environment may provide, and also to implement strategies to minimize downside risks, such as through hedging portfolio risk exposures or actively raising cash. We have a benchmark unconstrained approach to our flexible Asia bond strategy. This means the strategy is not constructed or managed with a benchmark in mind. Because of this strategy has no benchmark constraints around countries or sectors, and we flexibly allocate to areas where we find the best investment opportunities in the current market environment. For example, a volatile market environment can present good investment opportunities to invest in oversold bonds where we see that the underlying fundamentals of the issuer still remains stable. As we don't need to consider benchmark allocations, we can also totally avoid areas which we find as unattractive. In order to reduce risks, this strategy may actively hedge portfolio risks such as currency risk and interest rate risk. It also uses cash as an active asset allocation tool for when we want to move to a more defensive positioning. These characteristics of our dynamic benchmark unconstrained investment approach means that we can be more nimble to navigate a more volatile market environment.